In this video, we're going to be diving into the recent US macroeconomic updates. We're going to be looking at inflation risks, potential recession risks. We're also going to be taking a look at whether or not the Fed could actually cut rates sooner than expected. And we're also going to be looking at some other articles as well. So if you would like to keep up to date with what is happening in the US macroeconomic world, then please do consider hitting a like and subscribe. It would be greatly appreciated. With that being said, let's get straight into this video. So this week, the US Consumer Price Index showed an annual inflation slowing to 2.8% in April, the lowest rate since 2021. Inflation is getting closer to the Fed's 2% target, making markets excited about possible rate cuts in the future, which we will get onto in a bit. Core inflation, which excludes food and energy, also slowed slightly, a good sign for the economy as a whole for sure. I do think this is a good time to point this out. I am currently working on a mechanical approach to basically assessing the health of the macroeconomic situation within the states. And this is obviously a work in progress at this point, but I feel as if I'm getting somewhat close to having a formula set ready for this. And hopefully within the next couple of weeks, this will be something in which I can properly showcase to you all. So if you are interested in keeping up to date with this, then please do hit a like and subscribe. It would be greatly appreciated. But back to the topic at hand here. Lower inflation means the Fed has more room to ease up, and that's why Wall Street has been rallying this week. As we have obviously seen, we have had a relatively decent week, and tariffs are set to be cooling down now as well. But it can't be all sunshine and rainbows, of course, with articles like this saying that expectations of rate cut by early summer fade, essentially adding comments like a Federal Reserve May or June meeting seem more unlikely after the most prominent Dove member of the US Central Bank suggesting that he was in no hurry to make a move towards a federal rate cut. With him also saying here that Donald Trump's tariffs are unlikely to have a big impact on the US economy until after July the 1st, so they're basically waiting out to see what the actual implementations of this are. Therefore leading him to say that it won't be until way into the second half of the year before the Fed gets a better idea of the higher inflation and slower growth effects of the tariffs. But a lot of tech stocks have really broken out of their negative spiral this past week, with Tesla being one of them. Palantir is also another one. These are basically very reliant on potential rate cuts. The rate cuts would definitely help these sorts of stocks, but this isn't the only reason these have climbed up, obviously. But it is really weird to see that Tesla is up nearly 10% on the recent week, just because it actually did really poorly within its Q1 report for 2025, missing most of its estimates. But from a broad market perspective, the economy is doing well, with the growth rate being in a healthy position, as well as the industrial production index. Capitalization is actually in a bit of a negative spot at the moment, with it falling down, but unemployment is actually in quite a sustainable position as well, with it only being at 4.2% as of March 25. I don't actually have the April data here yet, but that will definitely be something in which will spike my interest when that is released, as that will be quite fundamental to see whether or not tariffs are having a positive or negative effect on US jobs. The idea is that it will have a positive effect, but it will be interesting to see if it really does. And again, for March, the labour force participation was also in an ideal spot. But with the 12-month inflation being slightly above the ideal, it could indicate why the Fed is still struggling to justify a rate cut. And especially when you have tariffs coming into this, it's just going to drive inflation even higher.
First tonight, the International Monetary Fund announcing today that the global economy growth is expected to slow down significantly due to tariffs and economic uncertainty.
Slower growth is also expected here at home. The U.S. dollar has fallen to the lowest value in 3 years. News 19's Payne Newman joining us live in the studio to explain what this all means and how it could impact you.
Tamika, Ben, the IMF projected that the global economic growth rate would be 3.3% this year. That was back in January. It has now dropped to 2.8%. In the United States, a 2.7% prediction in January that has now fallen to 1.8%. And while those percentage margins may feel small, they could amount to billions of dollars over time.
So of course the IMF basically saying this is going to have a massive impact on the US, with their economy projected to only grow at 1.8% over this next year, down from its previous estimate of 2.7%. And the IMF has also stated here that there is a 40% chance of a recession within the United States, which is of course something in which is going to scare the markets just intrinsically. It will be interesting to see if this has an effect on Donald Trump's perspective on his reciprocal tariffs, if he is actually going to continue to push these after the cool-off period has ended, or if he's just going to abolish them completely, which I think is what the market and what the global economy is just hoping for at this point. But as you can see here, the US economy is not the only economy which is going to be affected by these. Canada's also going to see a massive effect, along with Japan, the UK, Germany, which is now projected to grow at 0% over the next year. Italy and France are all going to see the repercussions of this. But in general, the market reaction is stocks are up and yields are down, which is of course really good. Markets loved the softer inflation print. The S&P 500 climbed about 1.5% this week, whilst Treasury yields fell sharply as traders priced in a higher chance of rate cuts by summer, which we now know is probably less likely. But in general, macroeconomically, it doesn't look as if the US economy is going to have a terrible week next week, or even for the next couple of months. It looks as if it's set to be on the right course, but when we do get that new unemployment data, that will be a key turning point, of course. But next week we do have a lot of earnings coming out for a lot of tech companies, which will obviously drive the market in either a positive or negative direction. On a Shiller's PE, we still look to be relatively overvalued. It has obviously fallen off quite massively in the last couple of, weeks, but I would like to see this continue to go down, and this only goes down if prices continue to fall or if earnings are absolutely spectacular. But the issue is with these earnings is that their outlook might be particularly shy, just because of the tariffs. Like we saw with Tesla, for example, they were getting quite a bad outlook just off of what they perceive to happen due to the tariffs. But despite Tesla having a really poor earnings report, we've seen good results come out of Google and Intel here, where we've seen them beat both estimates on the top end and bottom end, but it wasn't all good news according to this article. Despite the negotiations between the Trump administration and various countries around the world, the uncertainty around tariffs and their potential impact on the US economy has companies on edge, as we have seen in Google and Intel's outlook, with Intel saying the current macro environment will impact its second quarter revenue, and Google didn't offer much insight into the tariffs on the second quarter, with the Google CBO saying it was too early to comment on this subject. So we obviously have seen really strong earnings reports come out so far, with a lot of outlooks basically saying how they are unsure how tariffs will affect their business, but the risk of recession still definitely lingers. For example, the yield curve remains inverted. Short-term rates are higher than long-term rates, historically signaling a potential recession. And industrial production has flattened out, and business investing is definitely looking to cool. As we can see here, the recent report from, April, so this is up to date, is all the way down at 49 when the ideal should be at 50. Again, this is a work in progress, this system, so you will have to bear with me with this. I do plan on hopefully getting this finished and looking nice within the next couple of weeks. So if consumers or businesses start cutting back hard, we could see a trip into a mild recession later on this year. So what is the key data to look out for next week? Well, looking ahead next week, we are watching two big reports. The US job report, which I mentioned earlier on, we are waiting for. That will be quite a pivotal moment. And the IMF manufacturing index. Will factories show signs of life or potential slowdown? These numbers could totally change the opinion of the Fed, or even ours, as we could see potential markets start to fall. So I am going to end this video here. Where do you think the market will move in the next coming weeks? Do you think this new data is going to be positive? Do you think it will influence the Fed to cut rates sooner? Or do you think we are just going to see the stock market continuing to fall down? I hope you have enjoyed this video and found it somewhat useful. If you have, please do leave a like and subscribe. That would be greatly appreciated. With that being said, I will see you for the next video.